As in life and perhaps in fashion, over different periods and different time periods, the market favours different investment styles. This is the Moneymakers. I'm Bruce Whitfield. Tonight I'm joined by Jean Pierre Verster, the infinitely stylish portfolio manager at 361 Asset Management, and equally stylish in Cape Town, Grant Irvine Smith at Investec Asset Management, who also manages Discovery's Dynamic Equity Fund, to talk about investment styles. Let's go to Cape Town first, and to you, Grant. In terms of investment styles, what's your preference?
Well, for us, Bruce, I think the key thing for us is that we don't favour any one particular style. The key goal of the Discovery Dynamic Equity Fund, and in fact the funds I manage at Investec, is to try and deliver consistent peer relative performance over time. And we find the best way to do that is to be exposed to a number of styles. If you're exposed to any single investment style, be it value or growth or momentum or quality, most of those styles do produce good results over the very long term, but the problem is in the short to medium term they can underperform for fairly long periods of time. So what we believe is by blending a range of styles, we can smooth that performance profile substantially and generate much more consistent results for our clients.
Jean-Pierre, we look at it from an investment style perspective. I mean, in most cases people go, oh, I like growth. I want growth. Growth sounds good. But value, it's very attractive, and we won't talk about value funds broadly. It's a little unkind without a value fund manager present. But when it comes to investment styles, how much of it is science and how much of it is a little bit of potluck?
Over the short term, it could be a bit of both or even more luck, but over the long term, the luck would equal out and your actual skill would shine through. And when we talk about styles, in the short term, there could be an element of luck, but a lot of asset managers have taken style and actually taken it up a level to become a religion, to become very dogmatic about their style. And they think that's the only way to make money, whether it is value, which very clearly in the last year, 3 years, 7 years has not worked, whether it's momentum, that in the 90s worked very well.
And momentum has been very effective. Low interest rates around the world have made momentum investing a sure thing for those who've had the courage to follow insane valuations.
Correct. But all of these different styles work until they don't.
Yes.
So it's almost like Charlie Munger talks about the man with a hammer tendency. And that means any person who only has one tool in their toolbox, maybe just a hammer, sees every problem as a nail. So if you only know of one style, one way to make money, the moment the environment changes, you've got a problem, as many asset managers experience that problem.
Absolutely right. So do you have a preference, or do you also do a blend? It sounds like a decent wine, doesn't it?
Well, we are pragmatic value investors. So we still think value is the core. Value just means you're buying something for less than it's worth. Yeah. As easy as that. It's not deep value where you're buying something that's bombed out and you think it will jump just for a technical reason. It's not buying something for momentum just because the share price has gone up. It's being pragmatic, as a good business person would, looking at the details, building valuation models, bottom up, but still being pragmatic about one's approach.
No, it is about being pragmatic. I mean, do we put too much emphasis on this whole idea of an investment style? Grant Irvine Smith in Cape Town at Investec Asset Management, is there too much emphasis on investment style rather than simple going, hold on a second, there is value to be had, there is a business model that works, there's an environment in which this business model will succeed, therefore we will buy the stock?
I think that's exactly right. I think ultimately we're all trying to generate, strong returns, and I don't think people should be too dogmatic about which style those returns come from. As I said, for us we look at 4 primary styles. So the perfect stock for us would be something that's reasonably high quality, is attractively valued, is enjoying improving sentiment from the analyst community, and has strong momentum or supportive technicals. Now, obviously it's very difficult to find one single stock that ticks all of those boxes, because typically, high quality stocks do not trade at a discount. They're not also value stocks. And a stock that's enjoyed strong momentum is typically no longer cheap after it's had strong momentum for any period of time. But what we can do is at the portfolio level, by looking at all of these styles together, we can build a portfolio that has these characteristics. And at the end of the day, it's the portfolio return that we deliver to the clients. So if we can build a portfolio that on average has higher quality shares than our benchmark, on average the shares should be higher quality, for example, higher ROEs, lower, higher earning certainty than our benchmark. We'd like to see PE slightly below the benchmark. We'd like to see dividend yields ahead of the benchmark. On the analyst sentiment side, we'd like to be holding stocks that the analyst community is getting more excited about. There's some increasing interest building towards those stocks. And then the last confirmation is just to look at how the market is responding to those stocks. And if we can get confirmation from the market in terms of strong technical trends, that's all the better. So if we can build a portfolio that has those 4 key style tilts, if you like, then we're fairly confident that we can deliver strong and consistent returns over time. And this has been the case.
I love the sound of it, Grant, I really do. But in an environment where we've got 100 widely traded shares and another 300 that barely move on a daily basis, in an environment where then 1,000 unit trusts and 10,000 fund managers and analysts all sort of preying on the same small pool of equities, doesn't that change this game quite considerably? Because if everybody's looking at either one or all of those factors as well as they look to make decent stock choices.
That's absolutely right. We do have a fairly narrow market, certainly when you compare it to foreign markets where they've got a massive pool of stocks to look at. But I think what is in our favor in using this particular approach in South Africa is that for whatever reason, and this is quite peculiar to South Africa, the majority of investors, by far, I'd say almost 80 to 90% of investors in South Africa follow the value style, call themselves value managers. So that leaves many of the other styles quite underutilized, and that's a great opportunity because these, the market is less efficient in those areas because there's very few people. We follow a quantitative approach that blends these styles together. There's very few quantitative managers in the SA market. So as a percentage of total assets, it's very small. And so you get very few people actively trading stocks on those other, call them behavioral type styles like momentum and analyst sentiment. And so the market seems to be fairly inefficient in that area.
Jean Pierre Verster, I mean, what it sounds like, I mean, you talk about pragmatic investing, that's what he's talking about, isn't it?
Exactly. The dogmatists would say, oh, that's fine in practice, but will it work in theory? And I mean, that's exactly it. If you look at our equity fund, we launched an equity fund in June 2012. So it just had a 3-year track record, and we were the #1 general equity fund in the country. So it does work in practice. And it's not just a flash in the pan. Our hedge fund have outperformed as well. So, you have a lot of guests that wear very nice ties on this program talking a good game, but does it work in practice? Pragmatic investing, if you do it well, if you do it correctly, does work in practice, and we can prove it. So don't be persuaded by people who say all these nice things in theory.
What is the point? I mean, Grant's point here is, you don't want to get wedded to a single investment style, and the vast majority of South Africans take a value investing style because that's what Benjamin Graham wrote about in the 1920s and 1930s. That's what has served Warren Buffett and Charlie Munger so well, that you buy companies, you hold on to them for a lifetime, and it's easy to understand. The moment you start talking about blending and styles and stuff, the vast majority of us sort of go and switch off. Therefore, value investing remains a tangible proposition. You can see what's a high PE, what's a low PE, you can kind of gauge what a business does. You might have to wait a bit longer, but value surely is we're getting ever closer to value coming back in.
Well, I think what we're talking about is the term value. What does it actually mean?
Yeah.
And if you do go back to the writings of Benjamin Graham, he actually first starts with a qualitative filter. So value is not just a low PE, low price to book company. It's a high quality company which also has those characteristics.
So on this basis, Lonman wouldn't qualify?
Correct. So any value manager who's saying he's buying Lonman, he's buying Platinum because he's a value manager, doesn't understand the meaning of the word value, in my opinion. So be careful. Even the likes of Warren Buffett, what he's doing today is not what he did 10 years ago or 30 years ago. So people adapt as the environment adapts. That is a pragmatic style. And all the big names we know, all the billionaires out there, they did the same thing.
I mean, when we look at it in terms of the South African environment in which you're operating right now, Grant, I mean, markets are off their highs, probably by about 8 or 9%. There's potentially an opportunity. However, is there really an opportunity in an increasingly uncertain global environment? What's your feeling on markets and styles right now?
Well, I think certainly the global environment in terms of quantitative easing has made, navigating styles more difficult. Some people like to try and time styles quite aggressively, rotating their portfolio from one style to the next. And a very popular way of doing that is by trying to marry the performance of styles to the business cycle. Now, we find that, I think that is becoming increasingly difficult because it's for a start, you need to know where you are in the business cycle. and then try and overlay which styles you believe will perform best in the current point in the cycle. Now, the first step in itself is often when you look at people who've done very long-term backtests on these types of approaches, it's quite easy in hindsight to decide, well, from this period to this period we were in expansion and the next period was slowdown. But in real time, it's very difficult to know exactly where you are in that cycle. So just the first step of that process is wrought with difficulties. So our view has been the most important thing really is to diversify across styles. Secondary is then trying to dynamically weight towards the styles you believe will work best in the current environment. And the way we do it is not using the economic cycle. We prefer a simpler method. To me, simpler is always better, and the results are fairly decent, and that is by relying on some momentum in style returns. In other words, when quality is working, for example, it tends to continue to work for quite a while, and the same for value or for growth.
Smith, I'm going to let you go there. Thank you very much, Grant Irvine Smith from Investec Asset Management in Cape Town. No problem. Don't apologise. It's my rudeness interrupting you. So it's about simplicity. It's about consistency. Then, rather than trying to outperform every quarter, get a level of consistency and a bit of common sense. And just stick to it. Stick to your knitting. Don't try and outsmart the market.
Exactly. You could enter the asset management industry.
No, please don't make me do that. I don't want to be rich.
So if you build portfolios with various different risk exposures, various different styles, various different types of companies with different return profiles, they might work this quarter, other companies, other shares will work a different quarter, but you will have a consistent outperformance if you do it well, as we have shown with our funds.
Or you can buy Satrix 40.
Well, we've outperformed even those. So.
There we go. Yeah. All right, we have to let me get that in. Jean Pierre Verster, Portfolio Manager, 361 Asset Management, and Grant Irvine Smith. He's with Investec Asset Management in Cape Town. He also manages Discovery's Dynamic Equity Fund. Thank you for watching The Moneymakers. There'll be more Moneymakers tomorrow. Till then, good night.